Hi, everyone. So interesting discussion we have in front of us after the talk by Vineet. So on the Series A funding point of view, right? I just give you some data that 2011 until 2013, about $800 million were raised in early stage capital. That number moved to about $1.2 billion in 2014, depending upon the data you look at. And double of that, about $2.5 billion in 2015. This year, it's back to the same mean of about $800 million. So, Pankaj, opening the question with you, that is this the new normal? Do you think this is the new normal? Do you think that our companies and investors, are there enough companies that investors are seeing that are good quality and ready for funding?
So I think last year was completely abnormal. We were having a chat before this panel started about the depth of the market. The truth is that the startup world in India is still a very small part of the economy. So it's going to take time before depth comes in, before the overall market catches up with what startups are trying to do. So, I think there's a little bit too much focus on funding, and that's been the case for a while, and I blame the press for it. The truth is, let's focus on the fundamentals of these businesses. Fundamentally, there are a number of businesses that are very attractive, that look very interesting, that are doing things that will substantially change the way people work, the way people interact with technology, and the opportunities that that opens up for them. So I think focusing on those things is what we're trying to do, what we have been trying to do. I did 24 deals last year in India, but none of them were in sectors that were supposedly hot. I didn't do any food tech, I didn't do any AI chatbots or hyperlocal because the valuations were insane and they didn't make any sense. So I think focusing on fundamentals is something that's important, and being somewhat consistent in your approach is important. So, yeah.
And Gitansh, do you see, as a company, when you meet investors, do you really see the tightness in funding? Do you see that the market drying up, or there's no money in the market, as people say?
I think from the data that we have, the number of deals have not substantially gone down. It's the ticket size that has really gone down. And I think Series C or D, the deals are still happening, and those numbers are still in huge. The capex is quite huge. So I wouldn't say that the funding has dried for the startups which are actually performing good. Suddenly, what was the biggest reason was, earlier valuation was very much pegged to the kind of a market opportunity that somebody see. People thought, we're going to have a unicorn, next unicorn coming in India. And that's why people were pegging the valuations to the whole market opportunity, and nobody was asking, where will you use this cash? Is the cash burn, what sort of cash burn you're having at this point in time? What sort of a top line do you have? So earlier, I think in the phases, valuation was very much a number to the market opportunity that was seemingly pretty high. Now the valuations are pegged to the kind of a revenue, the top line and the bottom line that you have. And also the kind of questions are asked, what are you going to do with the kind of a capital that you're raising in? And if your unit economics positive, you're about to go cash flow positive, there's still some sort of a capital there for the good companies.
Right. Manish, let me get you in here. There is a fundamental rethink on what is the right number of mobile users, internet users in the country. What is their share of wallet? Where is the 20.01 millionth or 15.01 millionth, wherever you draw the line, customer would be, and what is the LTVC of that customer? But what has really shifted in, or what has changed in the expectation of an investor from 2014, 15 and now?
Great. Listen, let me just first throw in a bit of my comment on both Gitansh and Pankaj's earlier comment, because my answer would really link to that. So first of all, we have a classic problem of looking at the macro, and that is giving a bit of a flawed picture. So I agree with Gitansh. If you take out a bit of the froth of what I call temporary capital, a few hedge funds doing a lot of Series A and B deals, and two large institutions, we all know what the names are. If you take away the capital they were investing in this market, which was, I think, about $500 million per quarter, something, averaging.
About 1.4 between the two.
Yeah.
Last year.
So if you take those numbers out, we're still, at 2015 is where, the data peaks. So we're at a similar level, number one. And secondly, again, this is macro clouding the micro picture. I agree with Pankaj that 2015 is not the norm. So we will probably have to go back and look at how many Series A companies are getting funded. The numbers are similar again. So that's one point on, let's filter the data. And I must say, though, something which is a bit conflicting to what I said earlier, that the Indian market, like stock markets, does swing to the extremes. Whether there's media to blame for that or other things, we don't know. The market is not deep. So the issue that I face, just going back to our original topic, with where the market has swung to, is that while doing $4-5 million Series A rounds without POC, without a path to profitability, a path, you may not be there, was also not right. But at the same time, now saying that taking the bar up significantly as Series A has created this gap. So that's an interesting thing that the market is dealing with. Now, coming back to your point of what's the number of customers, I'm not going to be a favorite with entrepreneurs in the room, and I'm an investor, so I have to be careful. But that number is, a lot of people have sold the pipe dream of, 300 million smartphones and, so many internet connections and the growth. But if you look at, again, to use the word again, the depth of the market, I mean, most investors and an entrepreneur with a hand on heart will agree. Those numbers are somewhere in the, 10 to 20 million. So has the expectation changed? I think overall, I think investors, Series A investors and B investors are looking at the right things. Let me just put it that way. Paths to profitability, the single-handed focus on GTV or GMVs, cashbacks, discounts, some of those things are out and rightfully should be out. So I'd say it's back to basics and investors focusing on the right metrics. My only issue with the market is that it's probably swung too much to the right, and that doesn't help either.
Pankaj, you've been inside the market and outside, right? You have the benefit of stepping out whenever you want to. So what has been the new, when you say back to basics, Manish is using the word of back to basics. What do you think are the new basics of this market?
Exactly what Manish was talking about. I think, focusing on a path to profitability, lifetime value of a customer, and really understanding what the lifetime value of the customer is, focusing on unit economics, that's what everyone talks about. But the truth is that, look, at the end of the day, most investors are looking for a business or should be looking for a business. I think last year most investors went into a drunken frenzy and were just throwing out checks without really looking at those basics. And it's really the investors that have realized that, hey, we made a bunch of mistakes. We need to, get over our hangover and start thinking properly and investing in the right companies. So most investors have now realized, oops, we made a mistake. Let's start focusing on the things that are important, which is building real businesses. Hence, this year, funding in SaaS companies and B2B companies is up significantly over last year, right? They're trying to build real businesses. There's a focus on acquiring customers that are paying you. So the basics is business, right? It's not about funding. It's not about valuations. And, focusing on those, in my opinion, are the wrong things, both on the investor side as well as the entrepreneur side.
Ankit, let me get you in here. You recently raised a round of funding. Did you see the funding squeeze when you were raising money? Do you think you could have raised a slightly larger sum of capital, or did you have to tell an investor-friendly story as per the previous chat we heard when you were raising money?
Well, I think that's a good question. I think we were looking, in terms of capital, it's always good to have more, if that's the question. But I think we didn't feel the squeeze that much. I think so just let me get back to the original question of Series A and a slump over there. My personal belief is, irrespective of the terminology of the round, I think it's the milestone that's expected from a company to achieve at that point of at that point of time when they're going for the fundraise. I think seed or a angel investment happens on the pedigree of the founders, on what their experience. Your seed happens on the basis of a business plan that you submit, and your Series A is actually the most critical. At least in our journey, when we were doing Series A, we were trying to figure out a product market fit. I mean, you could have the best product out there. You could have a product like, I mean, a product which is like Practo, but if you're selling it to sports people, it's not gonna work. So I think the key was to basically identify who is that target market, which is gonna be totally dependent on a product like ours. I think if you're able to do that, I think there's no squeeze in the market, right? So even if you're able to justify and prove by data that these are the customer segment, this is a target segment that are people who are hooked onto your product, they're people who won't be able to spend a day without your product. I think that's where the key lies. Now coming to the point that, so I think money is there if you have the basics right and you know what you're targeting, right, and what your product is targeting. In terms of, so I didn't feel a squeeze at that point in time. There were funds available in the market for us. I think the key thing for us, is especially even and this is something that we have learned on our way, is when you're raising money, more than the valuation, I think it's what the investors brings to the board is important. So we actually have in our seed, and especially in the seed and angel rounds, we've opted to choose for investors who would add value to the business rather than the money that they bring. I have an investor who's in this panel who came in our seed round, and I think it turned out to be it turned out to be a good decision for us, right? Because I think these are the investors who would actually help you identify the target market, point you to the right direction, and that's what will make Series A easy. Going to Series B and Series C, I think Series B is when you are expected to reach scale. I think if you have identified your target market, there are different strategies out there which you can adopt to reach scales, right? If you fail on one, you can try the second one, right? That's where the money helps. And in C round, I think the thing that's expected out of you is basically unit metrics. But in today's economy, I think as everybody has pointed out, I think right from seed, I believe you should start figuring out what your unit metrics are going to be and how your business is going to shape up.
Sure. Thanks. Going back to data, right? The early stage deals, as the angel deals or the seed deals, if you look at the size and the quantum, it's not really much different from what has happened in the last 3 or 4 years. In fact, it's not really materially different from 2015 either. But angel onwards, there's been a marked drop in the number of deals and also the average size of deals. There's also an emergence of bridge rounds in the startup funding ecosystem, right? So Manish, what do you think is the role of a bridge round? I mean, is it that startups need longer runway to prove a business plan that they have promised to earlier investors for? Or do you think that it's a buying in time and trying to sort of get over the dry patch of funding in the market, which is, say, next 8 months, 12 months, or anyone's guess?
Sure. So look, the classic definition always was that the bridge round is a bridge to something, right? To something bigger. And it's pretty common in most developed markets, whether it's a bridge between A or a B, or especially between a seed angel to A. It's a fairly well-established market, like I said, in mature and developed startup ecosystems. Unfortunately, there's a bit of a lag effect right now. So you have a lot of companies that raised money, burnt that money, and haven't been able to meet the metrics they were supposed to have met at the end of this round. So we're seeing some of that lag effect where these companies are now, their existing investors aren't pulling up more capital. They're not ready for Series A. I'm just right now picking the bridge Series A bridge zone. And instead of raising the $4 or $5 million, which they thought they would very easily do, now they're staring at a scenario where they're happy with $1 million, $2.5 million, maybe $2 million, and they're raising it as a bridge. That is not the classic bridge, unfortunately, because it's just another smaller Series A, if you may. But I see the market is evolving to that point once the lag effect is over, and the classic bridge makes a lot of sense because we know this again from developed markets that I call it the last long mile, some people call it the deep valley. There is a lot of gap between seed, angel, friends and family, and institutional Series A capital. So bridge plays a very important and a significant role in developed markets, except right now all the bridges that we see are not classically what they're supposed to be, both from a valuation point of view and a structure point of view.
Gitansh, as an entrepreneur, how would you advise other entrepreneurs here to play bridge? I mean, it is fundamentally very different to plan a business on a lesser amount of capital as you think that you would need to go to the next stage, right? So you start off saying that I need $5 million at, say, at stage X,
Right.
and you end up doing a bridge for $2 million to $3 million, right? So how, as an entrepreneur, you think that companies should plan or entrepreneurs should plan a bridge round, which is a lesser quantum round, and B, reaching out to investors to fund you for that?
So, I don't have an experience with bridge, but what I can probably, say from the experience of speaking to several people, those who have been in this kind of a situation, bridge generally happens when there is no external interest. So that's when you end up, taking some sort of a bridge amount from the existing investors to reach a certain milestone. Now, from the investors' end and from your point of view also, you are very much sure what sort of a milestone that you want to achieve, where you will be back on the track again, where people will start seeing some sort of interest in your model once again. In the last phase, you would have made a bunch of mistakes, right? So, so that bridge round is to probably overcome those kind of mistakes, try a couple of new, guerrilla strategies, so that you probably reach that kind of a milestone where you are back on the race once again. So I think bridge is very much a sort of a union that you should present to the existing investors, keeping a certain milestone in head. That's what I would say.
Coming back to the early end of the curve, Pankaj, I'm going to ask this question to you. You do a lot of angel investments as a fund. What has kept the momentum in angel investments going? And there is institutional capital, and we'll touch upon it in the follow-on question that I have for Manish. But what do you think has kept the interest amongst angels going in the overall ecosystem?
So I think angels and early stage funds like us have continued investing because there are good opportunities. Valuations are lower than they were last year. Entrepreneurs are still going after real problems and trying to solve them, and there is opportunity for us to make money. A lot of angels have also seen exits, right, in secondary sales. So money has gone back into their pockets, so they're willing to start deploying that capital again. So whether it's through acquisitions or through secondary sales, there's more money for angels to go and spend. For funds, it's a little bit different. When we get money back, we can't spend it. We have to give it back to our investors. So it's a little bit different, but it gives us confidence to continue that process of investing in companies early, right? CardRocket, I invested in 3 years ago, and I haven't sold any of my equity in that, but because of the ability for CardRocket to raise more money, I feel confident in going out to other early stage companies and deploying capital.
Right. And if you look at the ecosystem today, Manish, there is about 73% of the angel capital is non-institutional. But we are seeing an emergence of a new breed of investors, the micro VCs, the institutional angel investors. What do you think about that? How is it evolving? What is the need for them for a startup? And how should entrepreneurs who are raising capital should think about their fundraise plans across the friends and family angels versus the institutional angels?
It's a pretty interesting question. And again, I'll go back to, I'm a believer of market economics. So I think there is a market need for a micro VC. Micro VC is not one of my favorite terms, but there is a need for institutional capital, institutional value add. Again, going back to my comment about the last long mile before the big institutional capital comes in. So I think there's a market need for it, and that's why you're seeing a number of funds. We're one of them that have raised money primarily on this promise that the opportunity set between non-institutional fragmented angel capital and the big institutions, there is an opportunity set here. How should an entrepreneur look at it differently? I'll go back to one of Ankit's earlier comments. I think the lens has to be sharper on who do you partner with in this zone. Again, this is the zone where it's called the deep valley for a reason, because the failure rates are maximum. And it's not an Indian market phenomenon, it's a global phenomenon. So it's pretty important who do you partner with at that stage. And in this zone especially, I think money has colors. So, it's not the dollar or the rupee check that you're getting, it's really who are you getting it from. And it becomes especially critical that you have people who buy into your vision, they see your passion, they buy into your vision, and they can help you, help the company get to a point where the large institutions can see the kind of metrics that we talked about earlier. So I totally agree with Ankit on that point that, it's important who do you partner with, and therefore my answer is that institutional capital is important because you need that kind of value add in the zone.
Sure.
I want to just add to that. In a market like this, I think a lot of entrepreneurs would disagree. They would say, all money is green, take it, right? And I think that's something to be aware of, and it's something to be weary of it as well. It is important to think about the investors that you are bringing in and do your due diligence on them. Talk to other founders that have received money from those investors that you're talking to and see how they behave when things get tough. And that's important. And that's what differentiates, maybe not colors of that money, but at least shades of green, right? And I think it's important to think about that, especially in a market like this.
Right. So, on the part of, fundraise from now on, right, and also the environment that is there today, and it's a question for all of you, and I think there'll be a bit of repeat when you answer. As investors and entrepreneurs, do you think you will build a different runway? Do you, from now on, given the fact that money is not available Series A onwards for companies or any fundraise onwards, the market is tighter. Do you believe that you will do different things or do things differently as companies, as entrepreneurs, and as for for both of you as investors?
Sure,
So maybe Ankit, you can start.
I'll take that up. I think what we are looking at doing is we definitely would like to have more runway. But as I said, I think the importance of having the right, again, coming back to my point about having the right metrics, having the right target market in front of you, you'll be able to achieve that, right? But now when we, as a CFO of the company, if I'm looking into basically devising a strategy and a burn rate for the next 12 months, I would like to extend it to 18 months for sure. Because I think now that if we're moving towards Series B stage, we are looking at basically, as I said, reaching scale. That's what we need to prove, right? That there's enough people out there, enough people in my target market who want to basically adopt my platform. Reaching scale, as I said, it's not the hardest problem, because the hardest problem I thought was basically figuring out the market. But now, when we have figured that out, I think reaching scale, there are proven 2, 3, 4 kind of strategies out there. We just need to figure out which is the right one. So obviously, there's going to be a lot of experimentation in the first 3 months, 4 months. But once we have the strategy right, I'm going to go all out. And obviously, as I said, I think if you're doing the right things, there's always money out there. There's always people out there. On the other side also, luckily we have some really good investors who are backing us. So I think there's enough kind of confidence, between, going back to point that Manish was saying, I think if you get the right person on board, there's enough confidence, and you can basically bounce ideas off each other and figure out that even if you reach a particular amount of scale, the money is still going to be there to take you to the next point, without the need of having a bridge, right? So that's what we are planning to do.
I think for us, when we started off, we was just at the end of the last era in 2014, when this probably the dry bit or whatever we're discussing today was happening. So, right from day one, we have been very, very conservative. We have been unit economics positive right from day one. So not much will change in our case, because what we right from the day one, we knew the fact that as soon as larger capital comes up, people start solving most of the issues in the company through money. Let's take up some person, let's take up more people, let's spend somewhere, rather than the equation, what can be the most efficient way to actually crack this kind of a problem. And I think I discussed this in the panel also. We filled up the team with a couple of Marwadis altogether. So I think, right from day one, that has been the approach. There's always a certain cash burn that we have, and we take most of the measures depending, what sort of with this kind of a cash burn, what's the sort of a runway that we have, and we have to become cash flow positive before that. Now you have 2 benchmarks. You can become cash flow positive in the next X months, and you have a certain cash burn. So you need to take capital to take these 2 benchmarks a little above. that should be the way to run the, as per us, that's the DNA that we have been following. Take the capital, take the 2 benchmarks up, and just keep doing that.
Just to add to that point, I totally agree. I think there's a ceiling. There's a ceiling. You just need to keep the ceiling up, right? So if it's a 12-month seal and you're looking to be EBITDA positive in 8 months, you can probably be EBITDA positive in 6 months and push that 12 months to 18 months, right?
Absolutely.
That's what the target is. And coming back to his point of Marwaris, I think there's at Cartrocket and Craftly, all of us, all of the people in the founding team are actually 30 plus with gray hair and lack of hair in my case. So one thing that we actually do when we are looking at any kind of a product or a vertical before we take it to market is we decide, we ask a question to all the founders that if we had our own money, and that's a big if, but if we had our own money, would we invest? And only when we are able to convince everyone that, you would put your own money in this is when we take it out to the investors and speak about it. So I think that's probably a good strategy to have when you're looking into planning a business or looking into an implementation plan for a business.
Manish?
Look, these gentlemen are, I think they can give a much better perspective because we sit at a point where we're hearing the stories, right, from a number of companies. But, I think Gitansh and his company is a classic example. They raised a Series A and a fairly large check size from an Indian perspective, Series A, in the so-called bad market. So I'd say, look, and I'll try to share the entrepreneur's point of view here again, that back to basics, figure out some of those things, other than cash burn plan, founder roles, resolve some of those things early. The classic concept of MVP, we call it MVE, just do a lot of minimum viable experiments. Don't blow a lot of money in those experiments. And don't believe in the gloom or doom. This is, as I said in my beginning message, filter out some of this temporary capital. The market is still strong. Good companies are getting funded. So as an entrepreneur, you should be out there networking, selling your story. And a lot of the times we underestimate this, especially here. I've noticed that, entrepreneurs are building their companies quietly, and I think there is no merit in that. While you're doing your operations quietly, you should be selling the story and letting the story be out for the next round of investors. People should know that you're coming. So I guess my overarching message is markets are still good for good companies, and investors are looking at what they should be looking at, back to basics.
Pankaj?
So pretty much everything has been said. I think my biggest concern for my companies is not the Series A. If they're not performing well and they're not able to get that Series A, maybe they'll raise a bridge round, maybe they'll have to shut down. That's the truth. What I am more concerned about is the Series B. There are very few Series B investors in the country. There's a big gap in that space right now. So getting that Series A, I think, is definitely easy for good companies. Cartrocket raised a large round early this year. 2 other companies of mine have raised fairly large rounds in the last couple of months. Another one raised a relatively small Series A. So I see that in my portfolio happening. It's getting to that Series B that I think is far more pressing of a concern. So especially with some of the large hedge funds and corporations that have slowed down their Series B or Series C checks, it leaves a gap. So there's an opportunity as well for folks that are ready to dive in and start writing Series B checks. There's a big opportunity. You can pick and choose the companies that you want to go to, and there are a lot of really, really good companies that are getting to that stage or are at that stage today. So, as far as what I'm telling my companies, I've been telling my companies for the last year, a little more than a year, that if you are going out to raise money, factor in your growth and think about raising at least 18 to 24 months of runway. Because I don't see the market really turning around at least for another 12 months, which is good because that means that we can get into deals relatively inexpensively at the seed stage. But having that buffer is really important, and I think, as Manish and everyone else said, focus on the unit economics, focus on the basics of running a business and not PR and marketing and getting up on stage, and just get the numbers right and money will come to you.
Series B onwards is a lack of depth in the market. The issue is the lack of depth in the market. So it's not going to get fixed soon. There's a fundraise cycle for funds. There's a fundraise cycle from LPs for GPs to raise money in. So hopefully, right, I mean, I think putting in the strategies of how to make your capital last longer and focus on getting the bar up, right, is the only way to, or lastly, use bridge to bridge this time in the market.